Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name is John Addis. I'm the founder of Intelligent Investor, and we have two guests this morning. We have Canadian Graham. How are you doing, Graham?
Hi, John.
You must be looking forward to the World Cup. I know how much you love sport, kicking balls around on a field. It's your thing.
I keep hearing that it's here somewhere.
I was hoping that they would move all of the US games to Canada and Mexico, so US wouldn't be involved at all, but that doesn't look like that's going to happen. I'm interested to see the reception that Iran get when they walk out onto the field in the US. Nick, how are you doing?
Yeah, I'm good, thanks. I am looking forward to the World Cup. Yeah.
So am I.
Pretty exciting.
It's just great that Italy have just this morning have failed to make their third World Cup. Just couldn't happen to a better team. All right, we've got three subjects this morning. We are going to talk about one of the weirdest sectors I find in Australia, which has managed to carve out for itself a number of sort of world-beating companies in poker machines, and some of them have actually originate in the same family. So we're going to be talking about that first, and then we're going to look at some of the sectors that we think have been whacked by AI and have got some interesting opportunities. And finally, we're going to address a very good member question on the difference between good stocks and good companies. All right, so Graham, let's kick off with Aristocrat. When do you think we first issued a buy recommendation on Aristocrat?
Oh boy, you're testing my memory now. I'll leave that to you.
All right. It was the
1999?
24th of September. 1999. Price at a review was $3.80, and it is now $45. And the reason why you wrote it up, one of the reasons why you wrote it up last week, is that just recently the share price has got as high as $75 and has now fallen back to about $45. So give us a story on Aristocrat, because we've had a number of buy recommendations on this over the decades. We've also had quite a few sells. It's been on a massive winning streak of late. What's going on with Aristocrat?
Well, it has been winning for a good 7 years since the pandemic. It has really turned itself around. Not that it was really doing poorly to begin with, but it's just continued to grow its market share from kind of 15% of the pokie market worldwide to around a quarter, 26% or so. And these days, it's got most of the top games, and it has that largest share. It has the biggest installed base in the US in particular, which is its strongest market. And so, yeah, in terms of since the pandemic, you could say it's just been kind of firing on all cylinders. The issue is that it seems to be that kind of good run is starting to end. And we can see that because the most important metric that a casino is going to be looking at when it comes to buying the next pokie machine is how much revenue that machine is going to make for the casino itself. We don't actually get those numbers. They don't publish them, but we can kind of see it indirectly by the fees that Aristocrat is earning. And so they do publish something called the fee per day, the daily fee for each machine. And Aristocrat beats basically every other company in that fee structure, which suggests that its machines are also out-earning all of the others, which then explains why it has the highest market share and why it's continued to grow over the last 7 years or so. The issue is that
briefly, can you explain who those competitors are?
There's a few. There's the other big ones are Light and Wonder, which is also on the ASX. There's Konami, and there's IGT overseas as well. So yeah, it doesn't have the feel to itself, but it's the largest and quite a bit better than all of the others. So you would say it's the strongest company.
And you base that on the daily fee that they're earning. So they're making about US $53 a day. And what are the competition doing?
Well, its next best is probably Light and Wonder, which is doing around $47 a day, US dollars. So we don't know the exact details that each machine is earning, but you can assume that Aristocrats machines are going to be out earning Light and Wonders because they have the largest share of the floor space on the casino. They can also get better deals, which means that daily fee is probably kind of understating the revenue compared to Light and Wonders. But the important thing is that Light and Wonders daily fees are growing, and they're growing by quite a large amount. In the last quarter, they were up 9% in the US, whereas Aristocrats are falling. Last year, they were down 4%. So it's not going to be very long at this kind of rate where Light and Wonders fees are outdoing Aristocrats, and that really changes the economics for a casino, because once Light and Wonders machines are out earning Aristocrats, it means each square foot allocated to Light and Wonder is worth a lot more than an Aristocrat square foot on the gaming floor. And yeah, then you can kind of see a reverse flywheel start to take effect, where the casinos start to withdraw their support from Aristocrat. They start pushing out more Light and Wonder machines. And then from there, you get this carry-on effect where suddenly Light and Wonder has the extra revenue to invest in better games and more marketing and all of that, while Aristocrats is shrinking, and so they then have less to invest in those things. And it can kind of set up the reverse situation of what we've seen over the last 6 or 7 years with Aristocrat, where it had that kind of positive flywheel effect taking hold.
Okay, so this is the rationale is that, from what I gather, Aristocrat has had a flywheel for a good few years now, and that might be about to sort of flip into reverse, or is already in reverse, and then all the things that started working for it will start to work against it. Can I just ask, though, I know in your review you said that 6 of the top 10 poker titles are Aristocrats, and it looks as though that might change over time. What is it? Because I go into when I see one of those poker machine halls or whatever they call them, I really can't tell the difference. They all kind of look the same to me, same kind of thing. What makes a winning pokey machine? I don't mean money-wise, but what is the most? What are the addictive characteristics of a poker machine?
Yeah,
that really appeal to people.
I find that a really interesting question too. In terms of the addictiveness of them, they're all very heavily regulated on the kind of underlying program. So I suspect that one is not necessarily more addictive than the other, because they're all working on that intermittent reward principle, and they're all following the exact same probabilities. So I'm guessing that there isn't some sort of difference in the underlying addiction of each game. What I think could be playing an effect is getting people to sit down at that game in the first place, which does seem to branding kind of matters, the game design matters. People do follow particular what is it called, themes, and the word is escaping me, but particular brands within the game. So like Lightning Link is a really big brand for Aristocrat, and they can pump that out in all different versions, and people seem to keep coming back to it. So yeah, there seems to be more a matter of how you can attract people to sit down, and then once they're sitting down, the kind of addictive quality kicks in and people continue playing. They've got the lights and the buzzers and all of that.
Right. Okay. It just seems like there must be a science behind this. I know that there was a social psychologist called B.F. Skinner who identified these patterns where you get rewards occurring unpredictably but frequently enough to keep you playing the game, to sustain engagement. I think all poker machines might work on that basis, but it's clear that some people just like the look of some machines over others, and I just kind of interested in why that might be. Maybe they had a big win on one machine and they just play that. I don't know. There
is a lot of gambler psychology behind it, and of course the casinos know how to play this to the extreme, as do Aristocrat and its competitors. So people have these fallacies in mind that if they've lost a certain number of times on a particular machine, then that machine is therefore about to hit the jackpot, or it's more likely to hit the jackpot. Likewise, if there's a rush of wins on a machine, they think that it's somehow a lucky machine and is going to play. There's all kinds of different psychological biases that keep people sitting down or moving machines. So the casinos unfortunately know how to play it
better than the players.
Yeah, much.
Okay, so you think that Aristocrat might be working on some more blockbuster products as they see this flywheel start to reverse? You'd imagine they'd have some games in the pipeline. How long does it take before we'll find out whether they do have some winners or not?
Well, that's an interesting question. They always do have some in the pipeline, but they're usually reworking a lot of the old titles that they have already rather than coming up with new ones. It's kind of the same principle as you've got to see another superhero film each summer rather than something new and interesting.
Okay.
Yeah, there will be others in the works. I'm not sure what they're working on currently in terms of completely new ones, but every now and then they do hit a good theme that kind of catches on. And in terms of how long it'll be, I don't know. I think in the short term there may not be much they can do because there is a lot of momentum in Light and Wonders games. Konami is turning itself around as well, so they over the next year, I wouldn't be surprised if the current slowdown and momentum continues. But looking a couple of years out, it could very well turn around again.
Yeah. So the last time the stock was around these kind of prices was back in May 2024. You upgraded the stock then, and it rose 70%. You did pretty well here, Graham. And then we sold out very quickly in November 24 after making a 70% return. So what's the rationale for not upgrading again now that the price is back down where it was a couple of years ago?
Well, in some ways, it's similar to why we sold. At that point, it was we considered it overvalued, and part of that was because we could see in the industry that things were possibly slowing down and not in Aristocrat's favor in terms of not so much its pokey division, but that it was expanding into even lower quality businesses than the original pokey side. So it got into mobile gaming, social gaming, online casinos and lotteries and that sort of thing, which is just a way more competitive space than pokies, where it has kind of a quarter of the market stitched up. So the issue is that was already starting then, and that's just continued. It's kind of doubled down on these other side businesses, which just aren't as good as the central pokies side. So, kind of a third of revenue is now not from what we'd consider the high quality part of the business. And that doesn't seem to be getting any better. In fact, that third of the revenue coming from outside it is getting weaker, where you see alongside it, just to maintain that kind of revenue, they're having to spend a lot more on marketing and user acquisition costs because they're competing against thousands of competitors. And that market is now kind of saturated, and so we just don't see that that's going to be very profitable going forward, and certainly nowhere near as profitable as the oligopoly that they have in pokies. So when you combine that shift to the share price where it is now, it is a worse business than it was 5 years ago when we upgraded, and so now we think that it's probably just not worth upgrading again.
Yeah, in the article you did still make the case for a bull case. It's got a massive install base. It's got a massive development budget in the industry. Not much debt. Great free cash flow, and they're doing a share buyback that's likely to boost earnings. But we're steering clear of it for now because we just feel as though there's much better opportunities on the buy list, and there's too much risk with this stock at the moment. You can go elsewhere and you get better value for less risk. Would that be right?
Yeah, that's exactly right. You've got to look at not just how Aristocrat's changing, but the other opportunities that we have out there. And we just think you're going to get more bang for your buck by putting it into these other businesses on the buy list that are of higher quality than Aristocrat. But there is a buy case for Aristocrat still, and it is probably a better case for it now at this price than it was when it was 50% higher a few years ago.
Right. Well, look, let's turn to those areas of the market that we are interested in. The buy list is getting bigger. We're coming out with lots of buy recommendations over the past few weeks. And Nick is here to talk about some of these interesting sectors. Firstly, Nick, do you want to talk about how when you get a boom in one area of the market, it just causes a loss of interest elsewhere, and that is where you often find the opportunities. This seems to me to be a regular feature of markets that get excited over one thing at the expense of others.
Yeah, it's happened throughout the history of markets, right? And I guess at the moment, some of the sectors that people are really enthused by are AI is one, gold and commodities is probably another one. We've created a new acronym, which is HALO, which is heavy assets, low obsolescence stocks, and they seem to be sort of in vogue. So anything that can't be disrupted by AI seems to have sort of caught a bid. On the other hand, anything that can or could potentially be disrupted by AI has been sold off heavily, along with sort of higher quality, higher valuation businesses. So there's been, a real sort of, I guess paths have gone both ways. So or paths have split here, and the momentum behind has really shifted now. For years, it was really behind these high quality growth businesses, and that's all dissipated over the last year or so. And look, there's no signs of it slowing down yet, but we're actually finding a lot more opportunities in the areas of the market that have been sold off. So it's really exciting, but there's been a whole lot of work to do over the last couple of months. I've been complaining to the team that I've been probably busier than I was in COVID, just because there's so many things to look at.
I don't know how many years you've been with us now, Nick. It's quite a few, and I've never heard you complain about anything once until recently. But I've got to say, it's a great time to have you on board, and you've been looking at some of these very interesting sectors. Maybe we can talk about insurance brokers, because we're not going to mention any company names here. That's for members only. But I think it is an interesting example of how an industry that looks as though it might be subject to AI disruption is probably not going to be that disrupted to it, but the fears create the opportunity. So maybe you could give us a brief overview of insurance broking, how it works, and why you think AI isn't a big factor.
Yeah, so I guess to start with, the fears of disruption from AI and insurance broking are really about this concept that AI democratizes intelligence and expertise and reduces friction. And if you think about what a broker does, it sits between a commercial, a business and the insurer. It brings expertise and advice to the business. So it can have almost like a level playing ground when it's going out to buy a policy from an insurer. So it reduces friction between both sides of the marketplace. And the fear is that AI will crush this friction. This might be the case with small businesses or very tiny businesses, and could be the case in personal insurance. But for larger companies, I don't see AI as much of a threat as the market probably does. And I guess there's probably a few reasons. If we start with what a broker does, it really does three things. So they organize and advise the client on and design the insurance program. They then go and shop those policies to an insurer to get the best price, and use their scale, because they're placing billions of dollars worth of premiums across different insurers to get a better price. And then another important bit here is most commercial businesses won't be able to place all their insurance with just, say, Suncorp. They'll have to place it with multiple different insurers. So there is natural friction here anyway. And I don't know if AI actually goes and solves that. A good example might be the World Trade Center. So pre 9/11, $3 billion worth of insurance was placed across 24 different insurers. So these are really complex transactions, and no single insurer usually takes all the exposure. And then the last role, and probably the most important role, and what you're really paying for, is brokers are there to advocate for the client when they have a claim. And this is extremely important because I think this is where the AI disruption argument falls down a little bit. So for all those roles, a broker takes between sort of 10 to 15% of the overall premium. And if we just go back to the claim situation, maybe AI can organize and give advice to a particular business. Maybe it can actually go and place that insurance. But what happens if you have 400 trucks and you're a trucking company and a couple of those trucks have a crash, which is bound to happen in that sort of business? Like, what do you do then? Are you ringing the insurer? Are you dealing with that? Are you prompting an AI agent to go and tell AIG to pay the claim, and AIG either says no? So this is where a human and a trusted relationship really, really matters. The other pushback I'd have against this case for AI disruption is the main cost here is to the insurer. So most of the premium goes to the insurer. So let's say you wanted to save that 15% that you pay to a broker, which, mind you don't see anyway. You'd still have to pay something to an AI agent, assuming it wants to be profitable. So you're not actually saving a whole lot of money. And then I just think, I put myself in the shoes of a business owner. If you're worth, say, I don't know, $30 million because you've got 100 employees and you've got that trucking operation, do you really want to save what might be a couple of $1,000s a year and risk your entire net worth to not have a sort of trusted relationship with a broker at claim time? I just don't see it being the case. And then if you're a large, it seems unlikely. And then if you're a large corporation, say you're Commonwealth Bank, if you're sitting in their risk management office and you say, instead of using, say, an Aon or a Marsh & McLellan, the brokers we've used and understand our risks for 3 decades, we'll do this ourselves and we might be able to save $1 million. Well, you better get it right, otherwise you're going to be fired. and so there's huge career risk as well with those sorts of with those transactions. Whereas if you're say a cafe and you just need maybe some basic business interruption insurance, some workers' comp, stuff like that, possibly you don't need a broker. But most of the broking relationships aren't with these businesses anyway. They're with businesses that are far bigger. So I think people here are confusing just because they shop their own or they buy their own personal insurance, online or do price comparisons, that now commercial insurance is going to work this way. If it was, the insurers would already be doing this, but market share, if anything, has been actually going to the brokers. I think people really respect this sort of relationship they have with their broker, and they rarely change, and they don't change because of price. They usually change because that relationship has broken down. I think that's really, really important and probably misunderstood. And then I guess you've got to weigh that up with where these companies are trading. And across the sector, we're seeing some of the lowest valuations in their histories or in their listed histories. And then some companies, are trading at sort of GFC-like multiples. And so it's pretty, it looks really interesting.
I mean, do you draw a parallel, or is there a parallel between, say, mortgage brokers? Because we kind of had the same argument 20 years ago, more than 20 years ago now, when the internet came along and said, well, this intermediation, there doesn't need to be a middleman anymore. We can computerize mortgage applications. Banks can process those automatically. The user just loads up the data, all of which has been true. And yet, the number of mortgages sold through brokers has just continually increased since then. And it seems like small business insurance is a more complex purchase and a more particular purchase than mortgages. And yet that disintermediation hasn't happened with mortgage brokers. They've actually grown their market share over the last 20 years.
Yeah, I think maybe a basic, human approach to these sectors is that there's a lot of distrust here. So people don't trust, Commonwealth Bank. They don't trust the large insurers, and they also don't see any of the savings. Like I have a home loan through Commonwealth Bank, and I also went to a mortgage broker, and I can tell you there was no difference between going direct and going through a mortgage broker. So there wasn't a better rate offered. There wasn't anything like that. And it's similar with insurance broking. Just if you go direct for your commercial insurance, I very much doubt you'll get an actual much better price than you're already getting through your broker. And so there's not any reason to do it. Then meanwhile, you can take out all of the hassle, all of the paperwork, and particularly with insurance broking, when your business is really suffering, if you've had a claim, then you can offload that work and have someone actually advocating for you. It seems to make sense. So I think one of the so I think it's distrust partly, and I think it's the other reason is none of these businesses have price signs in their window. You don't go past a broker and it says, business interruption insurance here for $1,000. Price is very opaque. Same in mortgage broking, rates are very opaque. And so it's very difficult to actually shop around and know if you're getting a saving or not. And I think, there's not a lot of evidence that suggests you actually do by going direct.
Yeah. No, I think you've made the case very strongly there, Nick. We've published some research this morning. We published some more yesterday, or you did, and I'm going to buy some stock in some of these brokers. But to know which brokers they are, you really have to be a member. So if you're not yet a member, and when you would like to be, visit intelligentinvestor.com.au and sign up to an annual membership. Now, thanks for that, Nick. We have one more quick segment to address. Graham, we had a very interesting member question last week. I don't know if you've got it with you, but if not, could you just summarise this question? Because I think it's something that's really interesting to a lot of people.
Yeah, so we got a question from Frank Yu. He said that 3 companies are currently not on our high quality list, but they're currently buy recommendations, which were Cuscal, Lovisa, and Premier. And he asks, what criteria were they fulfilling that would make them high-quality companies, and why are they considered buys at the moment? So it kind of gets to the question of this. There's a difference between a high-quality company and a good investment. And for those companies there, we don't think that they're high-quality companies. They have a few different issues in that they're either in retail, so they're quite cyclical, or they have too much debt and a few other things. But we do think that they're undervalued at the moment. So you can have a poor quality company that still has assets, it still has earnings, it might have brands or intangible assets that they can draw on, which means that we can value it. And then if we think there's a big enough margin of safety, we might still upgrade the company to buy, because we think that the current share price already compensates for those risks that we know of. Whereas you can also have very high quality companies that are in the opposite situation, where their qualities are known. Maybe they have no debt, they've got amazing free cash flow, high returns on capital, great brands or something. But at the same time, everyone kind of knows that, and so they're willing to pay this big premium in the share price, which means that the return you're going to get is going to be quite low. So you've got to separate in your mind that you can have a good company that is a poor investment, and at the same time you can have a bad company that's a good investment. And the best is when you get a good company that's also a good investment.
Nick, do you want to make a comment on that?
Yeah, I think Graham covered it well. It really it comes down to valuation. Great returns don't come from how high quality a business is alone. Otherwise, everyone would just do a screen to search for companies with the highest returns on equity, the highest operating margins, maybe some insider ownership and those sorts of things, create a portfolio around that and go to the beach. But that's not how it works. And we're sort of getting a bit of a reminder of that at the moment. Over the last year, a lot of these companies that were high quality or considered high quality and growth businesses, investors have seen like their share prices fall substantially. And previously, if we take out the last year, everyone was just like, oh no, these are great businesses. We can pay any price. Pro Medicus is a great business, so I can pay 250 times earnings for it. And that's just not the case. Valuation does really, really matter. And we're sort of getting a reminder of that at the moment. One good example, I think, here is a company that is on our high quality list, which is Wesfarmers. I'd argue that's a fairly decent business, a high quality company. Its main asset, Bunnings, has 50% market share in the home improvement market. Its return on capital for that business is 70%. It's a sensational business,
Wow.
but its revenue growth is sort of mid-single digits. There's not much margin growth. We sort of have a lot of Bunningses. There's not many new stores to roll out. So it's a more mature company. And paying 27 times earnings for that business today might not get the best return. However, a retailer or a commodity company or some of the company, Lovisa or a Premier that are on the buy list that are far cheaper but at low quality businesses, they actually might produce better returns despite being a low quality company. And so you really have to separate the quality of a business and the valuation you're paying for it. Like, valuation does really matter, and it does influence your returns. So I was just thinking before we had this chat, I should just put that up above my computer, because it's something you've got to remind yourself of. The price you pay does determine the end returns you ultimately get.
Yeah. I just want to add something to that because I think they're all very sensible comments, and this has a very practical implication. So, the value investing ideal is to buy great companies at attractive prices and hold them for a very, very long time. The problem with that is that those opportunities to buy great companies at cheap prices are just very, very rare. And when they do occur, it's normally because there's a couple of massive problems in the business. So you don't really know whether you're buying a high quality company or not. And so if you wait for those opportunities, you could be waiting years and years and years to build a high quality portfolio that you can hold forever. On the other hand, there are companies where you say, well, they're not great companies, but it's a really attractive price. And you will find that if you act on those opportunities, then your holding periods will be probably less than the holding periods that you have on those high quality businesses that you can hold for a long, long time. And that's based on price and the value that you get. And I think you should recognize before you go into a transaction what kind of company you're buying, because you don't want to get too wedded to the companies that are maybe of a lower quality, but you're buying them because they're cheap. And it's okay to make some good money over a holding period of 2 or 3 years. I'm not encouraging higher portfolio turnover. I'm just saying it's important to recognize the kind of company you're buying before you buy it. And don't think that just because you own it and it's quite good and it's done quite well, that's a reason for holding forever, because it can still be a low quality company at a cheap price, and that's a good reason to buy. And good companies turn bad too. So I don't know if either of you two have got any follow-ups to that, but that was my parting rant.
I think you parted well.
Yes, yeah. No, I agree. The only thing I'd add is just, that time is usually the friend of a high quality business, and it's the opposite for a low quality business. So if you are buying a business that you've acknowledged that is poorer quality, just be mindful that, of before going in, when you want to have an idea in your head when you want to get out of that business, so you're not wedded to the returns you've made, as you were saying, John. Because a lot of these businesses you don't want to hold forever, because eventually they will destroy your returns.
Yeah. Okay. Well, we do have we just revised the high quality hit list, which has about 20 odd stocks on it of businesses that we'd like to own and the price that we'd like to buy them. And this is one of those periods where you can buy. We do have 3 or 4 of those stocks on our buy list right now. So it is one of those times where you can buy good businesses for an attractive price. So if you do want to become a member, you get access to that too. We will leave it there. Thank you, Graham. You can go back to your football practice. Nick, you can go back to killing yourself on the insurance sector reviews that we've been doing. And I'm going to go off and finish the next issue of Pecuniary Interest, our email newsletter. Thank you both for attending. I'd also like to thank Steph, the returning Steph, who first started working at Intelligent Investor, I think, in 1999, and for some unknown reason is still here. She's doing other things in her life right now, but she won't tell us what they are. So listeners will have to wait to find out for the next episode, and I'll try and draw it out of her. All right, thanks, everybody. We will be back in 2 weeks.